Well, good afternoon, everybody. Welcome back to another episode of the Industrial Real Estate Show. I'm your host, Chad Griffiths, and I am very pleased to be joined by Asif Bade with Ambrose, who is a developer and an owner of properties all across the U.S. And we're going to talk all things industrial real estate today. Very excited for it. Asif, thank you so much for joining me on the show.
Absolutely. Thank you so much for having me today, Chad.
So I know you got your background. Your father worked in a warehouse. Is that correct?
He did. So I'm sitting in our headquarters office here at Ambrose in Indianapolis, Indiana, kind of right in the middle of the United States. And I grew up about less than 5 miles from where I'm sitting in our headquarters. And my dad, uh, for nearly 50 years, worked in a plastic injection molding factory on the west side of Indianapolis, less than 10 miles from our office here. In one of the largest industrial parks in the country. And when I told him at the age of 8 that I wanted to work there just like him one day, he told me to figure out how to own buildings like that instead. And I took him quite literally and went and figured out how to get an internship with the very company that owned that building, which was a publicly traded REIT called Duke Realty. And that firm just a few years ago was absorbed and acquired by Prologis. So yeah, that is a little bit of my personal background.
Yeah, and that was a massive acquisition at the time too. I don't remember the exact dollar value, but I think that's the biggest acquisition Prologis has ever made, if I'm not mistaken.
It certainly was one of the largest, yes, and I think that was now announced kind of in early 23 and closed in October of 23.
So you had your formation being in a warehouse with your dad, and then he having the foresight to say you don't want to work in the warehouse, you want to own the warehouse. So you went did the corporate route on the REIT side, big institutional player. I believe it was 2008 that you started Ambrose. Is that correct?
It is, yeah. November of 2008, about 45 days after Lehman Brothers had collapsed at the beginning of the Great Recession.
So what was that timing like to make a leap like that from the safety net of a large company where you're getting a steady paycheck to all of a sudden looking down the fire hose of having to be an entrepreneur and start from scratch?
Yeah, Chad, I can count on less than two hands the number of people that thought it was a good idea. And it would take me a lot of hands to count all the people that told me it was a horrible idea. And most of the people that I would count that told me it was a good idea have the same last name as me. So had a few early believers, mostly my family. But it was the right time for me personally at kind of a young age, 26. And I don't know that I foresaw exactly what was about to unfold with the Great Recession and quite how just how bad it would get. But I did feel like starting at a reset point in the marketplace could be great timing, and it seemed like from my take, it seemed like a lot of great companies, real estate companies, had been built during a recession or a pullback. So it seemed like a good idea at the time. But I really had my eye on a certain prize, which was after working at a large publicly traded REIT, which was a great place to learn and a great place to work with some exceptional mentors. I set out to found a firm that kind of really focused on making things as easy as possible for the client and figuring out how to say yes to them. And that was our simple vision at the outset. And we try our very best to keep our eye on that same prize today.
And it's paid dividends figuratively and literally. Wyatt, I'm going to ask you to pull up a stock chart real quick because to fully appreciate how bad things were in 2008, we could look at Prologis' stock, and I believe it went sub $2 a share in 2008. Maybe it was 2009. And for context, that's their stock is now 140 and in that vicinity. So for it to drop that much, there was so much doubt in the market, not just for individuals like ourselves, but institutionally. There was so much fear in the market at that time. To make that move is incredible and a testament to people like yourself who did make those moves and figured out that if you can make it in a bad market, a good market is that much more appealing. So faster, and why it's pulling up, it's just Prologis, PLD is the ticker. How big is your portfolio now? Because I know you guys do a lot of development. You've got modern investments all across the U.S. How big is your portfolio? What are you comfortable, I guess, sharing in terms of the size of your company now?
Yeah, sure. So Chad, we have built a firm that has done about $4 billion of development over the last 5 years. We have a portfolio of assets today that are uh, up and going, totaling about 30 buildings, about 10 million square feet. Uh, we are at about $2 billion of gross AUM. If we, having founded the firm in November of 2008 from scratch, there's been kind of a lot of iterations of the firm. And one of the things that we did, particularly over the first decade or 12 or 13 years, was we sold assets as the opportunity arose. So if we had never sold any of those assets, we'd probably be approaching about 10 billion of gross AUM. But we opportunistically sold assets as we were able to recycle that capital and continue to grow the firm.
That's impressive. Yeah, and in hindsight, it's always I wish I would have held on to everything, but it's tough when you're in growth mode and you need the cash flow and you need to roll it over into other operations. So yeah, it's difficult. But yeah, that's an impressive portfolio. I know you focus primarily on modern, and if you're building naturally, it's going to be modern if you're developing it. But you're even in the acquisition side, the focus has been on modern. If we could start there on how you would describe or differentiate a modern industrial building versus a call it a class B or maybe even just a vintage 70s, 80s building, which are prevalent. People are familiar with seeing those everywhere. Also familiar with seeing them in major areas now as well than modern ones. But how would you separate those if you were describing to a layman, someone that has never really considered industrial? How would you go about describing modern versus the vintage?
Yeah, sure. So for a little bit of context, Chad, the United States industrial market is comprised of about 18 billion square feet. Um, we what we consider to be modern, let's just say built in the last 10 years or so, comprises about 15% of that. Shockingly, it seems like warehouses are being built all the time, but only about 15% of warehouses have been built in the last 10 years or so. Um, and you know, if I had a few of my partners from the technical side, they would give you 100 reasons that differentiate a modern warehouse from one that is not. To keep it very simple, I'll focus on three things. One is pretty obvious: ceiling heights. So today we rarely see buildings that are less than 36 feet high, but usually 40 feet high. Number two is the flatness of the floors. And the importance behind the flatness of the floors is primarily driven by automation and robotics and its ability to work inside of these warehouses. So, and that flatness is measured uh, in millimeters, as opposed to any other larger unit of measure. And then number three, and it's a real hot button subject today, is power and power availability, both existing power at the building and the ability to increase that power load if a tenant requires. So I would say those are kind of the three things that highly differentiate a modern building from maybe the rest of the market.
We started very simple, but I'm already going to go 0 to 60 on this. And we'll circle back to some of the other points because I want to get your thoughts on the US market generally in different areas. But on the power side, because I find this very fascinating as well, is that 30 years ago, there's very little need outside of factories or manufacturing. There's very little need for heavy power. There were propane forklifts, very little to no automation. So you'd have power requirements for lights, heating, very basic operations. So these buildings were built with very little power. And then fast forward, and you have all this automation, robotics, and everything is connected to the grid. Electric forklifts, everything is electrified now. So the power requirements have scaled dramatically. When you're looking at a property, with power being what it is, a lot of the times some of these companies haven't yet adopted all this automation or robotics, but they plan on it. So when you're developing, how do you go about making the decision on how much power you're going to bring in based on the fact that the power company might not want to allocate a certain amount unless you're going to use it right away? Have you found that to be a problem? I guess maybe let's start there. Have you found that to be a problem with municipalities saying, if you don't need that power right now, we're not going to reserve it for you? And if you don't reserve it right now, it might not be available down the road.
That that is absolutely true on both accounts. Number one, sourcing or reserving that power is difficult in the first place. I think it's no secret that power availability continues to become more scarce, as there's a few, maybe one in particular, competing real estate property type in data centers that is um, taking a lot of that power capacity. So finding it in the first place is difficult. Number one. Number two, you're exactly right, Chad. It is uh, extraordinarily difficult to kind of leave yourself a ton of flexibility. So um, power purchase agreements, guaranteed guaranteed purchase agreements kind of over 10, 15, 20-year periods are things that we hear about. Those used to be in kind of very high population centers, maybe on the coast. Those were topics 3, 5, 10 years ago. Today, we see that kind of even throughout the middle of the country, places where it was maybe unheard of 5 or 7 years ago. Today it's much more commonplace. Of course, there are a number of places where it's not so limited or not as difficult. But that's really a huge differentiator as both occupiers and investors like us evaluate various locations throughout the United States.
If you were to go back to 2008 and put your developer hat on at the time and compare it to where we are in 2026, what would the change be from, call it, building a 300,000 square foot warehouse? And I know I'm asking you to go back nearly 20 years now, so your memory might not be as clear as it is right now. But if you were to go back to 2008, 300,000 square foot building versus building the exact same building right now, but knowing the either the current or the coming power demands from tenants, how would you say that that's shifted? And I know that that's difficult to quantify, but even just roughly, how would you say that that's changed in 18 years?
Yeah, absolutely. I think on average, and I don't want to quote specific numbers here, but on average, um, tenant demands for power have at least doubled, and in certain cases or in certain tenant types, um, they've increased 3, 4, 5-fold across the board. You know, even today, only less than 20% of warehouses have robotics and automation in them. So uh, the that usage still has a lot of room under the pedal. So we continue to see tenants increasing their demands for power for that specific need in big ways.
If you were to put on your or look at your crystal ball and extrapolate that out, does this continue to grow at that pace, or do we reach a level where companies have the robotics and automation in place and there is a steady amount of demand that's met by the supply, or is this going to be a challenge and a problem for the foreseeable future?
Yeah, I think look, there is a looming supply shortage for modern industrial. There is what I project to be a looming shortage for um, industrial development land that has sufficient power and entitlements available for development in the near term. And I think for a few different reasons, there will be kind of increased pressure on that. Those are all obviously supply side factors. On the demand side, look, the drivers that we see behind our investment thesis are a few different things. Number one, e-commerce continues to grow at a double-digit pace, and has um, is still um, has space requirements that continue to grow in a big way. That's one of the leading areas for modern industrial. So, and I don't expect that to slow down anytime soon. Number two, advanced manufacturing and manufacturing, both because the United States supply chain in general for warehouses, but especially for manufacturing facilities, is on average very uh, out of date and old. But also there are more manufacturers because of reshoring and onshoring looking to um, have new modern facilities. Um, and then just in terms of the United States supply chain in general, um, companies have continued to bolster their supply chains within the United States um, to to um, to solidify their supply chain and to modernize it with increased automation and robotics.
Yeah, well said. It's coming at both sides. It's coming on the warehousing side, and it's coming on the manufacturing factory side as well. So we're seeing a lot of demand for that. That leads me to the thread that I wanted to pull on that is when you're saying that your thesis, your bull case for it is positive on the warehousing side because inventory is is starting to be absorbed, seeing positive absorption. When you're looking at a site, though, are you or how are you contemplating the market itself as opposed to these broad macro trends? And I'll tee that up by pointing to a market like Dallas or Phoenix, where they added so much inventory over 2023 to 2025 that in some cases, some of their big box industrial was seeing double digit vacancy rates. So it's taken a while to chew through that. Whereas if you contrast it to markets that had land constraints, whether it's a coastal market or just markets where there's mountains or whatever that was geographically impeding new development, that it was much more resilient and it didn't see that bigger increase in vacancy rates. How are you evaluating different markets in that context where there are some that still have a lot of inventory to chew through, whereas there's other markets where there's a lot less?
Yeah, Chad, we are coming off of the best first quarter of leasing in the industrial market in history, about 250 million square feet. So again, a quarter billion square feet against total U.S. industrial market of 18 billion square feet. So massive amount of leasing in the first quarter. That's up 15% or so year over year. These are all, I think, CBRE's numbers from the first quarter. And then I think what's exceptionally important to point out, as you alluded to, Chad, there were a lot of very big boxes built in some concentrated areas, Dallas, Phoenix, and a handful of other markets throughout the United States. A year ago, early in the first quarter of 2025, there were 3 deals done in the first quarter um, at 1 million square feet or bigger. First quarter of this year in 2026, there were 23 deals done that were 1 million square feet or bigger. So um, that that kind of mega big box leasing volume has been um, extremely active. We've seen a number of those facilities get taken down. It's probably been the best performing sector of the industrial market, particularly for modern industrial. Um, and so, and we see that momentum continuing. There's a number of built to suit, of about 2/3 of the built to suit requirements that are active today are 500,000 square feet or bigger, which is exceptionally exciting. It's a lot of the large companies continuing to invest in their supply chain. There continues to be frankly, new user types going well beyond the advanced manufacturing and the e-commerce type of users that have become extremely active in taking down space. So, I think we're coming off of a great first quarter, a lot of momentum for the second and third quarter based on current activity levels. And I think you raise a great point of kind of both in supply land constrained markets and mountainous areas and otherwise, as well as areas that are a little bit easier to develop. Where do we go next? And so far, both kind of supply that's under construction now or planned supply is still fairly muted. It's deliveries, I think, are at a 10-year low in the first quarter. Again, I think I'm working off of CBRE's numbers here. Um, you have to look back to the first quarter of 2017, I think, to see a quarter with such low deliveries in terms of new product being delivered to the market. So it'll be interesting to see how the rest of this year plays out and as we look towards 2027. But what I know for sure is it's a lot harder to find land that's entitled, that has the power availability, and that's ready to go vertical. So I don't think we will see in years past when there's been this level of demand and potential supply demand imbalance. We've seen developers rush in and really start building pretty quickly. I don't think it will happen as fast this time around, and it'll take probably a few years to really see that resurgence of supply.
So naturally, you must be expecting, or as owners hoping for upward pressure on rental rates. Then,
We are and we do.
do you have any predictions on what that looks like, or is it site specific or location specific, or do you? I guess how do you underwrite? Do you say we're hoping to have 3% annual growth, or is there a benchmark that you target?
Yeah, we continue to see about 3% annual bumps, kind of contractual rent bumps in the deals that we're seeing across the country. May a touch higher maybe in certain places. In terms of rent growth, there have been places where rents have pulled back. There are places where rent has continued to see high single digit, low double digit increases in terms of just kind of market rental growth, rental rate growth. That very nuanced depending on the market, and usually actually not only the market but the sub market within those markets. Um, I think I think, Chad, that one other factor that we have to think about, and we're hearing that I word all too often again, and that's inflation. We're seeing um, pretty big, uh, you know, a lot of pressure in terms of fuel expenses, increased transportation costs, and I hate to say it, but I think we have and will continue to see upward pressure on construction costs. And so I think as interest rates stay elevated, or certainly don't pull back, as we see some potential increases in construction costs, I think we will, if this demand keeps up and the supply keeps shrinking, I think all of those ingredients will drive rental rates to creep higher.
Yeah, and we probably won't see much relief on the interest rate side because it's a bit of a misnomer where people focus on the overnight rate, or if President Trump comes out and says that he wants the new Fed chair to be putting downward pressure on the overnight rate. It's great for short-term loans, but the real estate functions off the 10-year, and the 10-year is pricing in all this inflation. So if the 10-year treasury keeps staying elevated, we're not going to really see much on the interest rate relief side, which is just going to even further add to inflation. So and then that makes it more expensive to build, higher construction costs, everything. So it's going to be fascinating to see that development pipeline. Like you said, are people are going to build, or what does that actually look like? As developers yourself, how do you make that decision? Or do you look to deploy into acquisitions right now, or you deploy into development?
Chad, we over the course of the last 6 months or so, we have started a number of development projects. We have a number of development projects that will start in the next next 60, 90 days. We have been and continue to be more and more active on the development side. We see great opportunity there, particularly kind of in the geographic area where we're focused, which is what I like to refer to as the middle 80% of the country, um, where supply has been especially limited, and leasing has been very strong. You know, my hometown, our firm's headquarters city, Indianapolis, actually was the top absorption results for the first quarter, over 5 million square feet, I think, again, referring to CBRE's numbers. So really, really strong results. I think there's about 3 million square feet under construction here, as opposed to 30 million, at the peak in that post-COVID boom. The 3 million that's under construction, I think, is somewhere between 60 or 75% pre-leased already. So, uh, that as a developer, especially my development heritage, that all sounds pretty good and exciting to get some projects going. Turning back to your question though, uh, we also remain very active and have acquired, a number of buildings, over the last 12 months or so, and remain bullish on the possibility of buying good modern industrial real estate, that maybe has a little bit of value add potential through mark to market, lease renewals, or maybe some lease up.
With the remaining time that we have, I'd love to dive into that middle 80% that you explained, because I find that very fascinating, where a lot of and I'm assuming that naturally excludes all the coastal areas. So you're probably steering away from these really hot markets such as New York and California, where it's been crazy over the last 20 years, but that also comes with a number of challenges. Is it a strategic decision to look away from those, or is it more just saying we see better opportunities in the inland? And maybe you could even define what that 80% is, if there's a geographical boundary for that.
Yeah, sure. So Chad, uh, we in essence, in terms of development, we do two things. We do built to suits for tenants, and that business we are geographically agnostic. So anywhere in the United States, coast to coast, we probably have folks in a number of states as we speak this week that are working on projects kind of all over the United States. When I refer to the middle 80% of the country, that's when we uh, have, you know, where we do speculative development. We control, buy land, get it entitled, and build warehouses. And uh, there are a few places kind of outside of the technical term of the middle 80% of the country, such as Miami and Orlando. We are very big believers in markets like Florida, where there's very, very strong demographic push, driven by the consumer. Uh, great fundamentals for warehouses. But beyond that, we kind of define the middle 80% of the country. Our team is very active, boots on the ground, looking for land, acquiring land, building and developing warehouses in places like Denver and Phoenix and Chicago and Indianapolis and Cincinnati and Columbus, in Pittsburgh, so on and so forth. So that's kind of the thinking. And you know that middle 80% of the country, for a variety of reasons: interstate access, access to labor, access to power, access to the United States population, for all those reasons has continued to perform very, very well. Um, and a lot of times it's uh, everywhere we operate has institutional ownership of industrial real estate, but it's maybe not as concentrated, or not there aren't 20 or 30 competitors of ours operating in that market like there would be in some of the coastal markets.
Yeah, very well said. I'll get you off because I know you've got another meeting to go to. But if someone's watching and they say, "Hey, I've got a perfect site to put in front of you," do you have a director of acquisitions, or what's the best way if someone wanted to reach out and put an option in front of you?
Yeah, absolutely. I think probably just through our website, we have the ability to do that. AmbrosePG.com.
Okay, well, we'll put a link to that. And then, are you active on LinkedIn or any socials? If someone wanted to connect with you, they could reach out.
Absolutely, very active on LinkedIn.
Awesome. Okay, I'll put a link to your website and to your LinkedIn, and I'd love to do a follow-up episode. If you're available, we can try and schedule something offline. But there's a number of other things I'd love to talk to you about, and that just went way too fast. So, if you're up for it, I'd love to do it again. But
Absolutely.
really appreciate your time and insights on this. Yeah, I could tell you're just a fountain of information, and would love to explore this further. So, thanks so much for sharing your time today.
You're welcome, and thank you so much for having me, Chad. It was great to chat with you.
Yep. Well, looking forward to the next one, and all the best this weekend, and we'll talk to you soon.
Okay.